Three, two, one. Hi, this is the Philosophical Angle, and I am your host, Chris Angle. Thanks for joining us. I am the author of 4 books on philosophy, one of which is The Nature of Aesthetics. These books are available free for viewing online at www.philosophypublishing.com. Along with me is my panelist, Rick Samuelson. Rick graduated from Yale, has an MBA from Wharton, an MA from Tufts, is retired from the investment banking industry, and is currently an independent venture capitalist. Welcome, Rick.
Thank you.
The purpose of the Philosophical Angle is to examine and explicate the nature of the concepts and topics being used in current media. And we compare its essence with the usage and circumstances in how they are being used. This week, the topic is really all over the news. It's the fiscal cliff. So let's begin in examining the fiscal cliff and its consequences and how to avoid it. Let's chart out a summary of what it is. As everybody knows, if you're reading current media, then on January 1st, 2013, just a few weeks away, the fiscal cliff, a term originated, I think, by Bernanke of the Federal Reserve, will happen. What happens? On that day, the Bush tax cuts expire, and so America will be in for higher taxes. Also, in the current administration, which was previously initiated in the previous one, but now in a runaway spending mode, is the U.S. government spending like all get out. However, a sequestration of some spending will occur on January 1st if no other deal by Congress and the President comes to pass. But basically, even if sequestration is implemented, still we have a runaway spending situation, something that's making us head for the likes of Europe, like Greece, like Italy, like Spain, like France. And the cause of this is the tremendous entitlements, and along with these entitlements is Obamacare, which is going to kick in, but that kicks in almost on 2 parts. It also induces higher taxes and induces more spending. And what happens when you get a lot of spending and higher taxes? There's a possibility, a great possibility, of recession. And in fact, we've seen some of that starting in Europe, and the possibility of that can extend here, inducing a relapse into a recession. What does a recession mean? It means less gross domestic product, less corporate profits, or profits for anybody. If you have less corporate profits, you're going to get less take-home pay, less government revenue. That's because people aren't making as much. The government will collect less. And what happens if they collect less revenue? The debt will go even higher because they'll have to borrow more to pay for the less money that's coming into the Treasury. What happens if you have higher debt and higher tax? Oh, well, look at France. It had higher debt, and what was their response? Their socialist government, newly elected, has increased their marginal tax rates up to a high of 75%, and the high earners are leaving. So higher taxes mean really less taxes probably. It's a vicious circle. And if a vicious circle like that gets into the US economy, it really means destruction. Eventual destruction of the way we've been living, of the standard of living that keeps rising. So the fiscal cliff is being negotiated by the Euro-Socialist Democrats, as I would like to call them, and by the Spineless Republicans. The Socialist Democrats want to raise taxes and raise spending because they feel that government is good. They feel like some other presidents in the past, such as Roosevelt, that the more the government can control, the more prosperous an economy will be. So they want to get control of both of these. The Republicans, spineless Republicans, they don't want to raise taxes, and they want to lessen the spending. But if they don't have a spine, they may assent to the higher taxes, and we will get higher taxes. This remains to be seen. And we don't know what will become of the negotiations presently underway. But within all this, there is a solution. There is a possibility of the Republicans coming up and saving the day. And that's why I call them spineless, because I don't think that they'll do this. There is something else on the horizon, and that is the debt limit authority that resides in the House of Representatives. And this debt limit has to be raised in order for the Treasury to borrow more in the near future. The debt limit will be reached, and to go above it, they need the authority of Congress. It'll happen in the next couple of months. Well, how is this a saving bit of information? Let's go to a second graph or picture of the situation. And you have this debt ceiling limit that looms here. And the other day, the Socialist Democrats, particularly President Obama, asked for control over the debt limit ceiling. A remarkable request. A power grab. Why would he want that? Because he sees it as his only weakness in being able to achieve or accomplish everything that he wants to accomplish. And that is, he will have freedom to initiate, or really to accomplish, his socialist agenda. Higher taxes, higher spending, Obamacare, as well as lowering the defense, entitlements everywhere, which will bring us to the runaway spending. So, on the other hand, the Republicans can control this debt ceiling limit. They don't have to raise it, and so they should not. The government would be pay as you go. Everybody uses the term, especially in the media, not pay as you go, but the government shutdown. It's not really shutting it down. As the money comes into the treasury, they may spend it. It'll be pay as you go, just like everybody else in this world. at least every other private individual and corporation has it. And that'll reduce government spending drastically. And it'll reduce the borrowing needs of the Treasury. They will only could borrow as they retire debt, can they borrow against that retired debt. So the limit on Treasury borrowing will happen. And this is essentially a tax decrease. Because if we go to the fiscal cliff and the Republicans and the Democrats do not make a bargain, the taxes will go up. And so to counteract that, if they don't raise the debt ceiling, it is essentially a tax decrease. You'll get less government spending and greater economic efficiency over time, because investments will seek return elsewhere. The return on investment will over time be greater in the US economy if borrowing is reduced. And so this will offset the higher taxes that are coming on January 1st. So it's a perilous situation, because the only hope for us to avoid a fiscal cliff and a recession is in the hands of the Republicans, who we all know are spineless. America's only solution to future prosperity, as we see it now, is through having a backbone of principles of limited government that they should honor and call themselves true members of the grand old party. I want to go back to one more point on this tax decrease. Other economists, such as Art Laffer, have pointed this out, that when the government that spends least or borrows least is essentially a tax decrease. So, with this in mind, let's go to Rick and ask his opinion of this whole mess.
Well, thank you, Chris. I'm a little bit of a crank in that I think we are already following Japan and Europe into recession next year. So I think the die is kind of cast there. It's a question of how deep that recession goes, really. And I can see some advantages in going over this quote-unquote cliff. One political advantage I see, two actually, is in the first instance, I don't see that cutting spending is going to get anywhere unless we cut across the board. That's going to be that will be actually the only politically acceptable compromise. So how and when we get there, I don't know. But if we went over the cliff, it would set that precedent. Two, if taxes were allowed to go up, we know that would depress the economy. It did in the case of Japan. It has in many other instances as well. And of course, wealthy people always figure out how to avoid taxes, as do democratically run corporations. And we've seen that in the news as well. They will always flee higher taxes, and they will always be successful at that. So the actual amount of tax revenue collected will be far less than is projected. That's always been the case. But if we were allowed taxes to go up across the board in accordance with this so-called fiscal cliff, immediately the middle class would understand what is actually going on. Because this is the end game for Obama's strategy. That is the ultimate end game. Taxes go up for everybody. It's a question of how much and for whom.
Well, this middle class, you say they'll understand immediately what's going on. What do you mean by that?
They'll be paying the bill at the end of the year.
And what bill are you talking about? In other words, are they also getting a tax hike, or?
Yes. If we go over the fiscal cliff, taxes go up for the middle class as well as the wealthy 2%.
And how is it going? How is it also going up for the middle class?
Well, because the Bush tax cuts will be rescinded.
Right. Okay. And if let's say a deal is struck whereby the Republicans do acquiesce to the Obama's requisition for higher taxes on the, as he calls them, the wealthy. Really, it's $200,000 and up, or $250,000 if you're married. And if that deal comes to pass, will they see? Will a recession happen, and will they see the middle class also see a tax rise?
Well, in that latter case, obviously the biggest burden would fall on this upper 2%. Fortunately, I'm not one of them. But it's small potatoes, of course. It might raise. Of course, the government has rosy predictions as always, and they're talking about raising at least $80 billion that way. I suspect it will be less. The middle class would be largely unaffected. But in any case, it's not going to make a material difference to our debt growth trajectory. We're still on track to spend roughly $1 trillion more than we take in. So we'll have $20 trillion dollars of debt in 4 years' time instead of 16 today. So doesn't solve the problem.
Well, how great of a problem is? In other words, we've got two problems. One problem is the higher taxation on the high earners. I don't really like to call them wealthy, because wealthy is not really 250 and above. But high earners. And then you have the problem of runaway government spending. So if some sort of deal is struck and the government can run away with spending, and you have the higher taxation on the high income, does this lead to a recession also?
It will aggravate what might have otherwise been a milder recession. Yes. I mean, again, Japan had tried this when they first entered into their lost decade, which is going on to be lost 2 decades. And it's always the same. You don't raise taxes in a weak economy.
Well, Rick, we've lost Rick here for a second.
Sorry, I'm here.
Okay, all right. So let's get back to the question, though. But how about the burden of the government runaway spending? Does that by itself, could that lead to a recession? Let's say the higher taxation on the high income doesn't have much of an effect on a possible recession. But how about government spending by itself? What are the implications of a runaway government as we have now?
Well, at some point, U.S. debt will be downgraded again. Difficult to know exactly when, because it's such a politicized issue, and the government can exert enormous pressure on the credit rating agencies. They're obviously not independent and not always rational. But at some point, the net interest coverage will have fallen so much that even Moody's and S&P will have to act, and Fitch. So that, in theory, should raise the cost of funding this federal debt, of paying the interest on this federal debt. And, of course, the whole model comes apart very quickly as soon as interest rates start to rise, whether it's because of a debt downgrade or inflationary expectations starting to feed into how debt is priced, or any of a number of other reasons. The relative value or creditworthiness of the U.S. compared to other trading partners, for example, could enter into that calculation. At any rate, the U.S. is paying historically low rates of interest on its debt. It's a few $100 billion. If interest rates return to anywhere near their long-term norms, the U.S. will be paying closer to $1 trillion on its existing debt and the debt that it's accumulating over the next few years. And then that starts to take up 30, potentially even 40% of the budget, or the revenue take, I should say, not the budget, but the revenue that we take in through taxes. And that begins to crowd out other programs, obviously. So the real question, Obama can keep this game up for quite a while until interest rates start to rise. Then the game's over.
Okay, so really the politicians can kick the can down the road, as it were, into the immediate future and still have a semi-prosperous economy. Do I read that correctly?
I wouldn't say no. The economy will not be prosperous. We will enter in the best case scenario a mild recession next year, followed by an equally mild recovery, much as we've seen over the last 4 years. So you will continue to see extremely high levels of unemployment. Bernanke's magic 6.5% unemployment number will never be reached in the next few years in that scenario. And in the meantime, of course, we run a constant risk of the dollar being egregiously debased.
Right, and that's right into that's a good segue into the next question, because first of all, you've got money coming into the economy from the Fed. Of course, he's not going to reach his goals of 6.5% employment, so so he'll continue to print money. That'll be probably putting pressure on the price of gold and precious metals and inflation, do you think? And if that happens, will that not cause interest rates to go up?
Yes. Well, yes. Ultimately, yes. The Fed's got a lot of firepower, and right now they're coordinating that with most of the largest central banks around the world. So everyone's printing money, which is quite a bit of firepower globally. And so it's very difficult to forecast exactly when inflationary expectations will start to overcome this this vast money printing rescue operation that's going on globally. I'm not smart enough to figure that out. I'm not sure anyone else is. All we know is the end game ultimately is inflation will rear its ugly head, and credit downgrades will also have an impact on the rate that any central government or any federal government or global government has to pay on their bonds.
What do you think might trigger the a rise in the interest rates? We know it's going to come, but what would trigger it? Do you have any thoughts on that?
It could be something like a war, frankly. Some sort of major conflict that erupts. There's suddenly a scarcity of this or that commodity, perhaps, or a disruption that leads to some sort of catastrophe in the supply chain of this or that good or that commodity that could spark it. Hard to say.
Agreed. I think it will come with the investors when they seek safe havens and realize that the safe haven is not as safe as they think it should be, in the sense that the devaluation of the dollar is happening. And of course, the way I think that it's being avoided by the administration and by the Federal Reserve is that there is no other safe haven right now. And so interest rates have not been able to have not gone up because money hasn't found another avenue to go. And so the Fed don't have to be attractive to be able to, or the Treasury, U.S. Treasury doesn't have to be effective or attractive in bringing money to its borrowing purposes. So it's kind of interesting, this point, this flash in the pan, this spark in the coal mine, this little, that will start it to happen. And it's interesting that you mentioned war, because that is a safe haven that money will seek, will run away from the war and seek a safe haven, which of course is the US dollar. So probably that, I may have to disagree that may not be a possible spark to, at least to increase the interest rates that are looming somewhere out in the future. Any more thoughts on this? It's a difficult problem.
I saw a presentation the other day from a professor at University of California, who wrote a book recently about what's happening with global currencies and the reserve status of the U.S. dollar. And his view, to me, makes perfect sense. We're moving back in time to a period when there was more than one reserve currency. I mean, that's inevitable. The U.S. dollar is not being managed prudently. And as long as that continues, there will be increasing pressure for central banks and others to trade or store value in more than just the U.S. dollar. You know, the euro is having some of the same problems. So even if it is also a weak currency, just because it is also a weak currency doesn't mean that investors, central banks, and others won't seek to store value and trade in another weak currency in addition to the dollar, which is rapidly becoming a weak currency. And others may be added over time, including, you know, commodity-denominated instruments of some sort. So I think what the U.S. is, the fire that the U.S. is playing with is ultimately losing its status as the world's sole reserve currency. And as that happens, whether gradually or quickly over time, you're going to see more pressure on U.S. interest rates, because the demand for dollars will be, over time, less relative to other currencies that are potentially reserve currencies.
Okay, I think that's a great point, and I think that the spark that will set off the interest rates will be actually the price of gold. At some point, it'll start to skyrocket again from its level, present level, and probably go right into the 2000s, and that would spark, I believe, an interest rate increase. That's all the time we have for now on this very interesting subject. I want to thank Rick Samuelson for joining us, and we'll see you next time on The Philosophical Angle. Thanks for joining us.
Thank you.